Over the years, I've noticed that I trade a lot more ETFs now than I used to. When I first started trading, I think, like most new traders, you focus on individual stocks, individual companies, right? You're going to find that undervalued company that's going to, 10x its share price in the next few years, and you're going to make a ton of money. That's what you dream of. You dream of hitting the home run. But as you grow older, you realize there's so much of a big volatility swing to that because you never know if that company is going to 10x its share price or maybe it's going to go all the way to zero and go bankrupt. A lot of these individual stocks, these individual companies, these are really high volatility plays and you really don't know where they're going to go. And the safer play, I think, is trading ETFs. ETFs are essentially a basket of stocks rather than just having one stock, right? You're trading a basket of stocks, maybe an entire index product like the S&P 500 or the NASDAQ 100, or it's a basket of stocks as far as it's a sector ETF, meaning we have all the companies in a particular sector of the market, such as the energy sector or consumer staples or home builders or whatever it happens to be. And this is a much safer place. And these days, it's a much more comfortable place for me to be in. So let me switch over to my trading platform. I'm going to take a look at Apple. Let's go ahead and take a look at the chart for Apple. And the reason I'm taking a look at Apple is as I'm recording this video today, Apple is going to report earnings after the close of the market today, and the market's currently open. So here in just a few hours, Apple will report earnings. Now, what will happen with Apple when it reports earnings? I don't know. It could go up. It could go down. It could go up 10%. It could go down 10%. Heck, it could go down 20% if earnings are really bad and there's some kind of bad news, in the press conference afterwards. Who knows? Or it could not move at all. It could literally not move a single dollar. You don't know. Now, Apple is not a terribly volatile company. It typically doesn't make gigantic, outsized moves on earnings the way another stock that is reporting earnings today typically does. This is Coinbase, and you can see the chart for Coinbase is much different. Coinbase, just a couple of years ago was trading for hundreds of dollars a share, and then it dropped all the way down to like $30 a share. And now it's back up to, well, they're just a few weeks ago, it was trading nearly $300 a share. As of today, it's trading $223 a share, and it's reporting earnings today. And if you look at the options chain, the expected move is $25 in either direction. So it's like a $50 range where, the expected move, remember, 68% of the time, Coinbase should finish within that expected range, that $50 range. So $25 up and down in either direction. That's a big range. And who's to say it will stay in the range? 32% of the time, it will move outside of that range. It could go up $100 after close today or down $100. You don't know, right? And it's risky on these kinds of individual companies because they can make such big moves. Would I really want to go and sell, a naked put in this thing or a naked call? Would I really want to do that? No, because if I sell this $270 call here at the 24 deltas with only 15 days to go, I'd probably go out a little further, but let's just stick to this option cycle. Well, what if Coinbase does go up $100 after the close today? And that actually could happen. That's not a crazy thing, right? Well, that would mean that it's going to blow past this 270 strike by about $50, meaning, just intrinsic value wise, I'm going to probably be down about $5,000 after the close today if it made $100 jump up on that naked call. I can't do that, right? That is too risky, right? And that's the thing with individual stocks, especially around binary events like earnings or even not earnings events. Sometimes unexpected news comes out. The CEO dies and then the share price collapses, or the CEO goes to jail, or there's some kind of scandal or some kind of event, and of course that's bad news, but sometimes good news comes out and the stock explodes in price. And again, if you happen to be short, for example, like short a call, that's a really bad thing that can happen to you. And, to just be on the safe side. These days, I like trading index products especially. So, things like SPY, which is the S&P 500. I don't have to worry about those weird binary events when I'm trading an ETF like SPY, which contains 500 stocks, right? This is a basket of 500 stocks, the S&P 500. So, will the SPY, drop 20% in a day or go up 20% in a day. Well, it happens, right? Markets do crash, especially to the downside. You typically are not going to get those crazy crashes up. That doesn't happen in an index product. But can the market crash down? Sure, crashes happen every few years. You can expect every few years, you're going to get that big move down where all of a sudden you're going to get that 10% drop in a day or that 20 to 30% drop, over a week or two, where the market really corrects itself in a big way. But here's the thing. If you're in individual stocks, guess what? You're going to get caught up in that too, because with SPY, if the market crashes, pretty much everything is crashing. It means all the stocks in the index are they're all coming down, right? Nothing's safe at that point. But what you do when you trade a ETF, especially an index product like SPY or QQQ or IWM, is you really avoid a lot of those binary events, like those earnings events. They don't matter anymore. Whatever Apple reports today, will it affect SPY? Yeah. SPY will go up or down a little bit based on what Apple does, but just a little bit, because Apple is a component of SPY. It's a few percentage points of SPY, but just a few percent, like single percentage points of SPY, right? Apple, again, it's a small percentage, right? So it's not like, if I'm holding shares of SPY, SPY is going to drop 20% today after the close. If Apple drops 20%, that's not going to happen. So it makes a lot of sense to trade index products like SPY for the S&P 500 or QQQ for the NASDAQ 100. And then these are kind of big products. You have to have kind of a big account to trade these, especially if you're going to do naked strategies. Now, if you want to do like vertical spreads and iron condors, then these are okay to trade. But what I really like here lately, I've been trading a lot more of the sector ETFs. The sector ETFs typically begin with an X, so things like XLF, for example. And this is the Spider Financial Sector ETF. And when we talk about sectors, the market is divided up, I think they divided up into 12 different sectors, main sectors. And then within the sectors, there's also individual industries within the sectors. But that's not important. Just know that there are a lot of these ETFs focused on a particular sector or a particular industry of the market. For example, XLF here is the financials. XBI, which I think I already have a position in, is the biotech sector ETF. I think I have a strangle going on in XBI right now, which has not been working well for me because I put it on a couple of weeks ago when it was way up here, and you see XBI has been kind of going down, although it's rebounded nicely here in the last few days. But I've been fighting a strangle in that. I've also got a strangle going on in the home builders ETF right now, which has been working nicely for me. The home builders ETF is XHB, but you can see this ETF watch list I have, all these that begin with X. These are the Spider Sector ETFs and industry ETFs. And these things, because they're a basket of stock, they are a lot less volatile. They're a lot safer as far as, like, if you want to do naked options, like sell a naked put, maybe you want to run the wheel on one of these sector ETFs. It's a pretty safe play because, you're not as likely to get that crazy, like, 4 standard deviation move against you in a sector ETF, which is a big basket of stocks, compared to just trading one company. Also, it's safer in that, for example, if I sold a cash secured put on one of these sector ETFs, like, I don't know, let's do XLE, the energy ETF. If that trade goes against me and I get assigned on that put, am I scared of owning shares of XLE, which is the energy sector? No, right? I'm fine with holding shares of any of these sector ETFs for the long term because it's a sector of the market, and I know the market tends to drift higher over time. Like, these are much safer as far as holding shares if you end up having to hold shares, where holding shares in an individual company is a very risky thing to do. And this is something, again, if you're a newer trader, especially newer to options, you may want to explore some of these ETFs, these index ETFs, some of these sector ETFs. As a matter of fact, I just talked about XLE. I actually trade XLE all the time, and I don't currently have an XLE position, the energy ETF. So instead of trading, for example, an individual oil company or an individual natural gas company, why don't I trade the entire energy sector with XLE? And this is a pretty good trading vehicle. XLE right now, IV rank is only 26, but that's, for an ETF, that's not bad. Like, I don't mind selling premium in an ETF with the IV rank of only 26. That's close enough for me, so I'll get naked in here. I'll sell a put. Actually, since I don't have a bias one way or the other as far as bullish or bearish, why don't I just stick to a neutral trade? Why don't I just do a strangle in this case? So I'm just going to do a directionally neutral trade, a strangle. You can see I'm going to receive a 110 credit for this strangle here. I essentially went about 16 deltas on each side. I'm going to receive $110 credit. My buying power reduction, it's only $1,200, right? And that's not bad for a $100 product. And again, because volatility on the ETFs, because they're a basket of stocks, volatility is a little lower. Your buying power requirement usually isn't too crazy like it is on a really volatile individual stock, like something like Coinbase, which we looked at earlier, right? It's going to have some huge buying power requirements on naked options because there's a lot more risk to trading a product like that. So for me, yeah, I would be fine trading this. Matter of fact, since I don't currently have an XLE position open, why don't I just go ahead and ship that bad boy? And I'm already filled, and away I go on that. Some other sector products. We have XLU, which I sometimes trade, which is the utilities sector. The utilities sector is kind of boring. It's very not volatile at all. It doesn't move around that much. So premiums sometimes are not great in this, and you can see it's a lower price product. But if I wanted to sell a 16 delta strangle in it, I would receive about 91 cents credit for a buying power reduction of about $1,000. I'm not crazy about that. Let's check out XRT, which is the retail ETF. I trade it on occasion as well. And this product, well, it's had a really good run up until a couple of weeks ago when it came back down to earth a little bit. This one looks like something I wouldn't mind doing a strangle on, a directionally neutral trade, because again, I don't necessarily have a strong bias either way. I would receive about $1 credit for that on a buying power reduction of only $842. The IV rank is 63, so that's a really high IV for a sector ETF. So I'm going to go ahead. And why not? I could put on some trades today, so I've got that working. So yeah, it's just something to consider. If you're a new trader, especially if you haven't run into one of these crazy outlier moves, because I've been burned so many times, trading individual companies where the stock will just go up 30, 40, 50% in a single day, or down 30, 40, 50% in a single day. And I will literally lose thousands of dollars within just a few minutes due to our earnings event or some kind of weird unexpected news came out. It happens, right? And that kind of thing, does it affect these ETFs, these baskets of stock? Well, not in a big way. It affects them, but in a much smaller way. So if you want to, just take a little risk off the table and be a little safer in your trading, check out the index ETFs and the sector ETFs. And if you want to learn more about various products that you can trade, check out my book, The Super Wheel Option Strategy. It's about my favorite option strategy, the wheel strategy, but there is a chapter in that book that I dedicate to the various trading instruments, popular trading instruments, including a lot of the very popular ETFs that you should know about. Peace, guys.